All right, so today is the December 13th, FOMC day. Uh, Anticipation for the market was long. This is our market dissection course and classroom session where we talk about how we could have potentially capitalized on the market. So this is that point where we go back in the nighttime when it's off hour session and we want to dissect and see, okay, if we played it, how could we have minimized losses or maximized gains? That's the purpose of this classroom session. So looking at today's price action, we came in obviously with the anticipation that we're going to go long. We know that the market is going to make new highs. So our anticipation going into FOMC was long. Today on market review, we talked about how the 15-minute time frame had already taken off from yesterday, and all we were looking for was a drop down into sell side liquidity to build something up to rally the market higher. So they consolidated price in this area all day, waited for FOMC to come out, and they blasted it up. So we're going to dive deeper into this price action tonight and see how we could have potentially capitalized on the market in this move. Whether we were short on the retracement or we were long for the continuation or discontinuation, that's what we're going to be taking a look at today. Obviously, we had sell side over here, we had equal lows down here, we had more sell side over here. So there was a lot of liquidity build up down here to rally this thing higher. So I'm gonna move the 15-minute time frame over. We're gonna look at the 5-minute and the 1-minute that we have, and we're gonna dive deeper into what each candlestick was telling us as this market was playing. So obviously I had this FVG marked out from earlier on in the day. Move this over. This is where my eye was, right here, in between these candles. Another one that I had an eye on was from this candle's low to this candle's high. So we extend that over. So as you can see, right before market gets FOMC news at 10:59, we have a drive down, and the way that this candle painted was very significant because it wasn't a normal just crept on down. It sort of stayed here, had a minor push up, pushed down, whipped up, and then aggressively pushed down and closed price down here. And at that point is where I said, watch this next candle just blast off. And without, blinking your eye, it's just literally just gone. So how could we have better played this, or how could we have better anticipated this? Well, looking at the FEGs that we had on the left-hand side that we shorted off from, these are the points that I usually look at to see if we're going to get an inversion to go the opposite direction. Clearly, we have buy-side liquidity marked out right here. Right there. So we're going to be targeting that. So this candle sort of pushed down, and then it pushed up and it closed, and then next candle blasted. Usually when I see a setup like this candle tends not to get, run out on the right hand side for a liquidity sweep. Usually there is a chance that it will, but it's very low. Now when I saw this creep up and push down and then another higher high, then I already know if this leg, because this right side is higher than the left side. So if this leg can't come break this structure, most probably it's just going to continue on up. Now, obviously, we didn't call anything there. We didn't want to trade it. Typically, I try to have tight stops, and especially in a market like FOMC where it's two-stage delivery, you have 11 o'clock news and then you have 11:30 news. So what we know about 11 to 11:30 is 11 o'clock drives in a direction, 11:30 usually reverses and goes in the opposite direction. So I wanted to wait and see if they're gonna set something up after 11:30. I've traded 11 o'clock before, and usually how it plays out for me, and I'm sure Eric is the same way, is we get into that move at 11 o'clock that it presents, and then we usually end up getting BE'd or stopped out of that position on the 11:30 reversal. So I wanted to be patient today, looking at the market to see how it was gonna, trade and come back down to these levels. But on this push down, this was an aggressive push down right here, this one candle, this one right here. So that was a very aggressive push down. So just looking at this candle, I was like, okay, but here's the thing. You have to understand this. You have to understand the timing of the candle, right? Now, if I go to that candle, what time is that at? That's 11:31. So if I'm paying attention to the 11:31 candle, which is the first candle of the 5-minute candle, I want you to envision, look at this candle right here. It's this candle that we're talking about. So if I had a minor push up and then a big whip down at 11:31, then most probably it's going to come in and fill that wick on the top side right there. So this candle, once it pushes up without breaking this structure, that's a major part of it. So notice how this candle can't make it down here, for example. It just stops right there. Now, where does this stop? That's the first candle up right there. Did it break the OB candle? No. So if I were to take a box and I were to draw it like this on the body, I always take the body. Did any of those two candles close below that body? No, they didn't close below that body. So on this next one, open, had a minor push down. Typically, what ends up happening with that minor push down is this. Retail sees this move and they see that aggressiveness in the candle and they start panicking and they go short, but they throw their stop right here as this candle is going bear to break down lower. So they trigger all those orders, faking out retail, and then instantly they reverse this and push this thing up. So that's a clear indication that this thing is probably going to be heading on up. Now, if you didn't take this, you could probably take it right here. You take it right here, you throw your stop right below this candle right here. Realistically, you would want your stop loss down here, but if that's too big for you, then you can just throw your stop down here. Now, as this thing carries on up, it goes up, it goes up. I want you to pay attention how these candles are closing. So this candle pushed up, this candle repriced that wick, and then next candle made a higher high. Following candle, higher high, weak bull candle. Next candle looks like a retracement candle. That's not a strong bear candle. Next candle, if I had pushed up over here and then started painting down, so it would look something like this. If this bullish candle painted like this, we would be having a different conversation. But it didn't paint like that. What happened? Well, it tapped in 50% of that wick right there, held that, and started moving higher. Now we have a higher high. We have a higher high, and then we have another higher high, and then another higher high, and then a retracement candle. Still can't break through. And then we get another higher high. So at this stage, we were already playing in this range over here. And I want to focus on this range. So whenever I see, okay, this thing pulled up, and then I get these two candle closes right here and right here, I'm waiting to see how they're going to trade that candle. If you want to take a risky long position, this is the spot to take it at. Stop loss goes right below that low. That's a tight stop right there. But this initial push up is a big push up. So if I were to look at the risk to reward on this, this is probably 1 to 4, 1 to 5 trade right here. That's something nice right there. But as these candles were playing in this area, things got messy. So that's when I came into the team and I said, whatever you're thinking about doing, don't do it. because I could see all these wicks. I could see all these wicks. And I just want to let the market play in this area. We've already had a massive push up, and this is where all of this is happening. So my eye is on not only the 5-minute, the 15-minute reprice over here, but all these things that are going on. Now, on the 15-minute, we left behind this inefficiency right here. So I know that it can't just go in a certain direction. The market works like a rubber band. Every time it extends too far, it has to reprice a little bit. It has to balance out some sort of inefficiencies in order to be able to continue in the direction that it intends to go. So when I was looking at this, I was talking about it as we were watching it, and I was talking about how this 1, 2, 3 could be potential triple divergence. Now, on the 5-minute, it didn't look too triple divergency to me, but on the 1-minute, it did. And we have that inefficiency on the 15-minute left from here to here. So my target, if I am short, I know that it's just going to be a retracement. I know it's not going to come take this candle over here. That candle is done. It's considered this the breakaway that nobody caught, that nobody can get into this candle and, you know, feel confident in their move or hold it for a long period of time. So anyone that did enter this candle, most probably they had buy stops here that got triggered up here. As soon as this candle closed, they got scared and closed it up because they know they're playing FOMC. So I need you to think of the psychology that's going behind the candlesticks and how they're telling you what's going on, how they're printing you the story. So now let's dive into the retracement move on this over here. So we had a candle down, we had another candle down, we had a third candle down. Is anything left behind from here to here that isn't repriced? No, everything is repriced there. Now, if you see this bull candle right here, is that a healthy candle? No, that is not a healthy candle. This candle is a healthy candle because it tapped past this candle and then it moved up like that. But anytime you get a candle like this in a weird spot like that, that's not a healthy candle. So I knew that if this candle were to paint down, then most probably we're going to target the 1150 candle, which is this over here. How do I know that? Well, the rule of triple divergence is market moves like this. That's triple divergence. If it's going to go short, then it's going to catch this level. This is going to be the take profit on the triple divergence setup. 1, 2, 3. That's TP. Now, if this TP breaks, comes back, holds that, and goes, that could happen too. But you need to understand what's going on the left-hand side. You need to pay attention to what there is on the left-hand side. What day am I playing? What market condition am I playing? What is the higher time frame saying in the area that I'm seeing this triple divergence? And the market is nowhere for it to be a short setup. So as this thing was rallying over here, I was telling the guys, don't even think about taking the short yet. We need confirmations. We need confirmations that this thing is going to go short. However, when I saw this breakaway over here, this one candle, this big candle, I said if we can't break this FVG that just got created by this doji candle and this big bear candle, if that FVG doesn't break, as in it doesn't come up here and do this, then this thing is probably going to short off to what level? The inefficiency left behind on the 15-minute time frame. So we realized that, okay, we had a candle up. Let me clear all of this. We had a candle up, weak. We had a candle down, trapped orders. Anyone that's thinking it's going to go short now, trapped orders. Immediately they open the next candle, push it up, take out that high. And most probably their stop losses on those orders were above that candle because they're terrified to go short in a market that's just straight rocketing up on this side. You got this big bear candle down that fills in. Look at this inefficiency over here. Look at between these two candles right here, there's that inefficiency. So when this candle drops down, it clears that inefficiency. Next few candles are very whippy. When I saw this candle paint, I said that's the liquidity grab to drive price down. Why did I say that? Because we had a liquidity candle already. There's no reason for this one to go any. If price is a short, that's the spot. The close of this candle is the spot. Next candle opens, drop. Next candle, low whippy. Next candle, drop. Following candle, drop, and then the big one comes. But again, inefficiency left behind over here. Inefficiency left behind from price over here. So when we participated in these shorts to fill up, again, the 15-minute inefficiency, I was talking about how it's important to take massive profits on that rundown. So let me clear all of this. Let's go over here and dive a little bit deeper into this move over here. So I want you to pay attention to this bear candle. Not this bull candle, the bear candle. That's the important one. Okay? Now I'm going to take a fib. I'm going to draw it from the tip of this down to this level. Oh, would you look at that? What did we hold? The 50%. That's your exit. That's the OB candle. We just held 50% of the OB candle, and this market on the 15-minute is heavy long. On the 5-minute, it's heavy long. Neither on the 5-minute nor the 15-minute has a flipped structure. Sure, on the 1-minute, it flipped structure. But I talked about this. I talked about how if this thing is going to retrace, because it will, because I know that after this initial breakaway gap on the top side, you got 2 retracements before it drops heavy. Okay, I need you to pay attention to this. This is the first one. This is the second one. If that thing breaks, I want to see how hard this is going to drop. Could this take out the structure? No. We did not take out the structure on that drop down. This candle on over here did not take these areas out. If this next bull candle right here had painted once again like this, then it would start targeting this full candle range over here to come take that low. Because anyone that was retail entering long in here, their stops, if they were confident enough, were going down here. But clearly there wasn't enough. There wasn't enough liquidity build up over here for this thing to drop down. I need to do that. This range was enough. To tap into this range, they triggered enough stop orders to be able to carry this price higher. So how do you recognize that? We held 50% of the OB. So right at that point, anyone that was short, I was talking about how it's important to clear out profits. One of the guys texted me. I told him kick it out. He literally texted me back all in caps saying, all of it? I said, yeah, all of it. 100% cleared out. I don't even want you to hold that BE runner small position. There's no point. Because it hasn't flipped the structure. So as I'm watching this, I talked about this candle. And I talked about how if this is going to go short, if this is going to flip the 5-minute structure, then this candle that I have over here can't be broken. typically, when I see a retracement move to go short, what I like to see is a few bull candles up, one bear candle right there. On the second bear candle, I want to see this thing start flipping structure. So I'm going to dive into this area now. Let me delete this. We don't need this anymore. So we're focusing on this candle right here. Okay. Now, I want to give it a little bit of playing room over here, but not too much. Now, I want you to see how I determined and why I said what I said. I said something very important right at this minute, right here. I said, if the next candle can break this wick, I'll go short. If it can't, and it paints a big bull candle, I'm changing my bias back to long. Why did I say that? Because usually when I'm looking for a retracement move and you got a heavy drop and then a rise up, what I typically like to see is one bear candle, two bear candle, and then a little bit of lagging over here, and then it's starting to drop again. But as soon as I saw this candle closed, I said, nope, we're going to go break high. So the reason that I said that is because exactly of this. Now, let's go back to something that we talked about a little while ago. This TP on the triple divergence. I want you to notice how the candles play off of that spot. And I want you to notice how you see right here on the 5 minute, you have a candle and then nothing in between these two up until this wick. So there hasn't been anything priced in this area. So if I were to take a box and I were to draw it from that wick down to here, and let's make this one red. Notice how that candle played there. So all of these things were very important things that I was watching. Now, let me ask you a question. If this candle, let's dive into this area now. So my eye is automatically on this candle over here now, because I would like to see this stay open. I don't want to see that get traded into. But the 5 minute has this FVG down here, so there is a high possibility that we could, because this right here, these two candles, that's not bear. That's full-blown bull. If this was a bear structure, it wouldn't look like this right here. It would be very different. It would have a big whip up into this area left behind. Let me extend this out. So between this candle and that candle's wick, it would have a whip up into that area, potentially close small bull, and the next candle would have a small wick up and a continuation drop to take out the bull candle's low. But we got one small bear candle with a long wick to the downside, and we got another small bear candle with a long wick to the downside. That's when I was talking about over here. If this thing breaks up, this thing is going to shoot right up. What did they do? They pushed it up, tapped all the orders, because retail sees this as a bull flag. Tapped all of retail's orders, and retail sees this. They're looking at this as a bull flag like this. And the retail concept says that as soon as price breaks out of the flag, your entry should be right there and your stop loss should be underneath the flag. So look at what they did. Triggered them immediately without even blinking. Flipped it and triggered their stop losses. So what does that tell me? That tells me that we're 100% going to go long. Because we just pushed up. I have the bull structure right here. That's the bull structure. But This thing is gonna push up, trigger them, trigger their stops, and then it's gonna go. And I literally said, did you see how they just did that? They pushed it down straight into the FVG, left behind in price. Right there. And then they carry it on up. So how can I play this? Because I know they stopped out everyone that went long in this range over here. So what I want to do is I want to come in and I want to wait. I got one bull close. Someone like me that's played this market a lot, I'm confident to enter. On that big bull candle, I'll enter. I know when it's going to go. Like, that's it. Like, I know when price has been priced in, and I like from this point, it's just going. Like, I don't even care. Like, if it has, you know, if the next count opens and just wicks down and pushes up again, doesn't matter. It's gonna go. So I don't care to pop in a trade right here like that. And just throw my stop right below. So that's my stop loss. From there to there. I know it's gonna go up. What do I have on the upside? Well, there's this FEG over here that we're gonna target. What does it do? Pushes up. Now this from here to here. That's inversion. Taps into the inversion with that low wick. Next candle, up. It's gone. You've heard me on session say, oh, it's gone. Why do I say that? Because I'm watching levels like that. Those inversion levels where it'll tap into it and then it's going. There's no way it's coming back there. But let's keep moving forward with price and see how price reacted off of all the levels that we had marked and everything that happened. Let's first mark out this over here that we've been talking about. I want you to see how this played. So this is all going on. Comes right back into this. Can't break down past that candle. The 1150 candle. From there, market opens, drive up. Get that. When the market is on a mission to get to a certain level, once it starts that move, nothing is going to stop it from getting there. It's just going to magnet to that level. How many times have you seen in the nighttime just market, you came in the next day and it's at TP? They spent all day in consolidation, set it up, PM session, went in the direction, you came in the next day, it's at TP. Why does that happen? Because once everything has been balanced, it's ready to go, and nothing is going to stop it from getting to where it needs to be. This market is an efficient market. Nothing is going to stop it from being an inefficient market. No one is going to make this market become inefficient. It's fully efficient all the time. That's why you'll reach for liquidity grabs. That's why you'll do this. You know, as a new trader in the beginning stages of my career, I used to know these things. But psychologically, I would tell myself, like, nah, it's not going to happen this time. That's so wrong. Just wait. For example, I would see this push up in my retail days. I would see this push up. I'd be like, there's no way they're going to balance that range. This range, they're not going to balance. That range, they're going to balance. So if somebody is a scalp trader, then why wouldn't they clear out full partials over, full profit over here if they entered on this candle over here? What's stopping them? You need to understand that the first gap is typically not going to get filled. The first push is not going to get filled. when was it? I think it was Tuesday or Monday, where we took those longs at the inversion on the 1 minute off the low. And me, Eric, Levon, we were all in it. Everyone was in it. Rob was in it, blah, blah, blah. How do I know that's not going to get filled? How do I know that position is protected? Because I know that that's the first one. That's the first one that it expanded from. Now, everything else in between can get filled in. So if I'm holding that position for 150 handle TP, I'm okay with it pushing up initially when I enter, and then it has a retracement leg, and then another push up, and that next push up is gonna get rebalanced. That's how I know those things. So these are all things that you have to understand. That you have to understand that this is how the market plays. So that's when I started becoming more patient with my entries. That's why when I see this candle push up over here, I don't care to enter that. If I wanted to enter it, I'm going to wait until that gets repriced. And then I'll enter it. On that next side, same thing. Left leg, right leg. So that's a little brief market dissection class. Again, December 13, FOMC day. Market is, if it hasn't already, it's gonna break all-time highs. I'm pretty sure it's broken. Dow already broke all-time highs. Nasdaq is on its way. But that's all, folks.